Hi, welcome to another Bond Smart Investor video blog. I'm Marilyn Cohen, president of Envision Capital Management in Los Angeles. Usually this time of year, the financial press is full of all kinds of ideas on how you individual investors can save on your income taxes. Well, rarely, if ever, or is there something new? Is there a new idea that you're going to learn? It's just mostly a refresher. Well, my idea today is not new either, but it's rarely used. The name of this video blog is Amortize, Don't Capitalize. Visualize in your mind, you're walking down the street and you see a pile of money. You don't know whether it's $3,000, $5,000, or $7,000 until you count it. Would you pick it up? My guess is the answer is yes, you will pick it up. What happens if you walk down that same street at the same time of year and you see the same pile of money? Would you pick it up? Absolutely you would. Well, that, ladies and gentlemen, is what is awaiting you if you have a bond portfolio of taxable bonds. That means if you personally own, outside your tax-deferred account, corporate bonds, could be investment grade or high-yield bonds, treasury bonds, Fannie Mae, Freddie Mac bonds, but they all have to be taxable bonds. If you own those bonds and you paid a premium for those bonds over the last couple years, don't allow your CPA to capitalize that premium. What does that mean? Well, in plain English, it means if you bought a bond for $115, that's $1,150 for every $1,000 face value. Over the life of the bond, as you get closer and closer to maturity, that bond is going to approach par value, $1,000 a bond. But you have an election on your tax return, and that election is to amortize rather than take a capital loss at the end, the capital loss of $150 per bond. What you do is you tell your accountant, you don't ask him, you tell him, amortize my premium. That means you will get a deduction each and every year until the bond matures, is sold, or is called. Wouldn't you rather have a deduction today at today's high tax rates than a capital loss, not even tomorrow, way down the road when the bonds finally come due? Most accountants are a bit lazy, and so they don't like to amortize because they have to do amortization schedules. Well, if you are with a professional bond manager, which we are, Envision Capital, we tell our clients, have your accountant amortize and take the amortization as a loss against, well, actually it's not a loss, as a deduction against the income. This way you have a deduction today at these high rates. After all, I don't know if you agree with me, but the government is confiscating much more of our hard-earned and unearned money. Why would I want to wait 5 years, 8 years down the road to get a capital loss, of which I'm only going to take $3,000 a year unless I have tons of capital gains? So that's why today I want you to Google up amortize premium on taxable bonds, and you'll see there's lots of articles, and it tells you have to make an election. It tells you can take your pro rata portion annually as a deduction, and it may not be quite like finding cash on the ground, but it's going to be more money in your pocket that you don't have to pay out to Uncle Sam. I'm Marilyn Cohen. Thank you for joining me for another Bond Smart Investor video blog.